This is the biggest flaw I see in a lot of small businesses. When we up and coming or we already established, you're just making decisions based off impulse or what you heard on TikTok. TikTok is not the end all be all. TikTok is not, that's not, oh, TikTok said create an S Corp. So don't do that. Speak to your accountant first.
All right, so we are finally live. We're finally live. It took us like 2 years?
Yeah, it's a
2
long
years
time.
to get here. I think it's your fault. You've been procrastinating.
Okay, I'll take that.
So you know what I mean? So we finally live, and this is our first episode. So we just want to start it off like basically to get to know who you are.
Okay.
But first, before we do that, this is Wealth Without the Gamble. This is our first ever episode where we be teaching finances and teaching you how to build generational wealth without putting your money at major risk. So we're gonna start with you.
Okay.
We want to start with you because you do a lot. You wear a lot of hats.
Okay.
You wear a lot of hats. So what is it that you do? You do bookkeeping,
bookkeeping,
taxes,
tax preparation, tax planning, insurance, life insurance,
infinite banking.
Yeah, infinite banking.
Just to name a few.
Yeah.
So before we get into all of that, because you do a lot and you get into a lot. I mean, you helped a lot of people, and you have a lot of success with it. But I just want to get into who you are first.
Okay.
And like, what molded you? Like, what molded you to become who you are today? Like, go back to that little girl, that was raised up. Like, tell me about her that created you.
Okay. So, So as a child, this is kind of hard, actually.
Why? So what makes it hard? What makes it hard?
It's not a specific question, I guess, but
like that drive that you have.
The drive,
okay, yeah, that drive.
Well, the drive that I have, it comes from how I was raised, or it comes from seeing my mom. The struggles that we went through, the things that we had to endure. So by me seeing that and experiencing that, that is what pushes me and actually motivates me to do what I do, so that I can create something better for, my children or for my family. So I can be, the best that I can be as a woman, a mother, a wife, all these things. So seeing, the things that we had to deal with, the struggle is what made me.
Like, what kind of struggles did y'all face?
I would say the struggle that a lot of, Black families face,
I mean, because like the type of drive that you have is very caring. You care for a lot of people. You try to make sure, like, whatever you do for someone, you want to give them your all. So what was it like if you could take it back as far as you can, like if you like, your first ever job or whatever, like what was it that sparked you that like, man, I don't want this to happen to the next person, so I want to do this?
It really just comes down to the struggle, like me experiencing that, and I'm like, okay, I don't want to have to go through this for the rest of my life. I know that there is a better way out there. There's an easier way. It don't have to be this way. That was the main thing. Naturally.
So if I asked you, like, what was like growing up, because we all face struggles,
right?
What would you say would be like one of the biggest hardships that you faced, and you was like, man, I really overcame that?
Coming up.
Like, what was it like? Like me, my thing was coming up. I had a fear of speaking, being around people talking, like how we on the podcast right now. And then it took like us, our hardship that we faced in marriage. And I seen, okay, I have a family to take care of. So it took me 30 some years to be like, man, I gotta speak. You know what I mean? I got 5 kids to take care of. So it was, things that I went through as a child. I had to overcome it. So what was it like, one of your things? Because I know it's not speaking. So what was it? Something that what's something that you had a fear of, and you was like, man, I really had to overcome that.
If you want me to be completely honest, the biggest fear I had coming up was death. That's what I feared the most.
Why is that?
I don't know, but I never thought that I would make it to see past 18 or to graduate school. I don't know. That was one of the biggest things for me. I never thought I would see to make it to have children. So when I made it to those things, when I made it to that day that I graduated or that I went to college, I had kids, I was like, oh my gosh.
I mean, but
the world is here.
What in the world? Like, what happened? Like, what? You won't live in no street life? No. Like, I mean, like, what was it that happened at such like whatever age, and you like, man, I don't think I'm gonna make it past 18.
I don't know,
because I felt the same way.
I always thought the world
type
was
of life I was
end.
living. You know what I mean? I'm thinking like, man, I remember my teacher. It was 10th grade year, and she was asking me what I wanted to be in life, and I was just saying, I just hope I make it to 18. So the thing is, what was it that you was going through in life that you was like, I don't even think I'm gonna have kids? Like, you got 5 of them now.
I know. I don't know. I just always thought the world was gonna come to an end. I could never see myself being an adult, and I was in such a child mindset. I'm like, I can't see myself having to pay bills.
How old were you?
Young. I probably ever since I was a little girl, the whole time. It didn't change until I think my mindset didn't change until I got to high school. And then I'm like, okay, it's getting closer and closer. But I never thought I would make it there.
I'm almost 18.
Yeah, I'm almost there. I'm about to graduate, so I don't know. So that right there, once I seen that I made it to a certain, in life you have goals, I'll say. So once I hit, I guess that certain, it wasn't a goal, but once I hit that milestone, that's what it is. Then I'm like, oh, okay, well, it's a world out here. There's things that I need to be doing, even though behind the scenes I was preparing to live in the world because I already knew, hey, I want to go to school to do accounting. I want to be in criminal law, until I change that. But all through that,
you was preparing for.
I thought the world was gonna come to an end, so I thought I was gonna.
So all right, okay, we still here.
Yeah.
You passed 18.
Yeah.
I don't want to give your age out. So all right, we still here. Mm-hmm. So what was it? And do you remember when you overcame like the fear of death?
The fear. Okay. You want me to? Okay. The fear of
honestly, like when is it that you was like, man, like, okay, I have a reason to live?
When I overcame the fear of death, it was when I understood who I was.
Okay.
So that's when I truly overcame the fear of death.
Okay.
So,
okay. I like that. So you found out who you were.
Mm-hmm.
How old were you?
I think I was 19, 20.
Somewhere around there, right? So
yeah,
you found out who you were, and it took that fear away.
Yeah, it took the fear away.
It took that fear away. So if you could go back to that little girl, mm-hmm. and you could give her some advice, what would you tell her?
Oh, this is what I would tell her, because this is what always bothered me.
What would you tell her?
Seriously, this is exactly what I would tell her.
What would you tell her to take that fear away?
To take the fear of death away? Oh, to take that away.
Yeah.
Okay, to take the fear of death away. What would I tell her? This is kind of hard.
It's
kind of hard.
You got that little girl,
mm-hmm.
and say, for instance, it's your daughter, and she came up with that same type of fear, and you trying to comfort her, and you giving her something that you know is true.
Right.
And you saying, hey, I faced that same situation. You ain't got to worry about it because of this. What would you tell your daughter or yourself if you could go back and say, hey, this is why you don't have to worry about that fear anymore?
Well, because, when you pass from here, you're going to have eternal life. According to thus said the Lord. Lord's willing, if you're keeping the commandments now.
Lord's willing.
So, so the thing is, this is the easiest way.
You don't automatically get it.
This is the easiest way I can say it. if you're, doing thus said the Lord, keeping the commandments as best as you can, even the least commandments, if that's all that you know and you're doing it to the best of your ability, then Lord's willing, something happen, you pass in this world, the Lord raise you up when we take back the kingdom.
So I ask you this. I want to ask you this. If that little girl takes that advice, the fear of death is removed from her.
Right.
How fast you think you will move today? How far would you be today?
Oh, much further, because the Lord said He don't give us a spirit of fear. So much further. But I look at it as a part of my journey.
Yeah.
It shaped me and molded me. Even though it's a possibility someone could be, or I could be much further, but it helped shape and mold a lot of things that are around me and within me.
I truly agree, because people don't understand like things that you probably didn't went through in life. I didn't went through in life.
Right.
And all they see is us right now, and how they say however they see us.
Right.
But they, but the thing is, in order for us to be who we are today and be able to speak the way we speak and move the way we move is because of those experiences, those trials that we had to face.
Right.
Even like with this a financial podcast, but it was experiences that you had to go through,
right,
in order to, do what you do now.
Right.
So like, let's go into one of the things that you are great at. It's not a lot of people that do what you do when it comes to infinite banking.
Okay.
So give me a little understanding of infinite banking.
Okay. So a little understanding of infinite banking. The best way that I can say this, if I'm just speaking about infinite banking, it is not how you have always been taught to think about whole life insurance.
Right.
We were taught that life insurance, that's for something for when you die. Right? They don't teach you, okay, no, this is something you can utilize now while you're living, and it don't have to take 20 and 30 years.
You sure it ain't a scam?
Positive. When I learned it, I couldn't believe it. Was hard to grasp it because I've been taught something one way.
Right.
So I had to unlearn everything that I was taught.
And you was taught this, like, okay, let's bring it back. So you're an infinite banking practitioner. You've been doing it for 3 years now. But you have background with life insurance.
Yeah.
You've been doing this for how long?
I've been doing insurance for 11 to 12 years now.
12 years. So you have the understanding of traditional life insurance,
right,
term policies, what, just to name a few. So you know the background of these things and how it works, and you sold a lot of it.
Yeah, right.
So and just for a little more background, like when it came to like companies that you work for, like were you like one of their top agents?
Yeah, I was top. Like the last company I worked for some years ago.
What was the name
I
was
was top company? 3. That was Florida Blue. But that was dealing with.
So what was Gant? Like I remember you was with Gant.
Oh yeah, that was for auto.
Okay.
Life insurance, I was on my own with life insurance.
Okay.
So I didn't work for. I did work for a company. I'm sorry, I did. That was United. So I did work for them.
That's the name. That's the name. I
United,
think of
that company. There is a company from my childhood, but I did work for them selling life insurance, traditional life insurance. And when I started working for them and I seen their rates, I was like, oh, okay. I'm thinking this is the end all be all.
Okay, help me out.
So their rate.
What is a rate?
So a rate is how much you pay for insurance. That's how much your insurance costs you. So you may be 30 years old and it may cost you, let's just say $50 a month for a $50,000 whole life insurance policy.
Okay.
Right. So that's when I was really introduced to the life insurance side of the business, when I worked for that company.
Okay.
With the life insurance side. So that company actually, I learned a lot, but then it wasn't until I met a lady later on in the years that showed me, oh, this is another way you could sell insurance. And she showed me how it was cheaper. So that's when I left United in order to help.
So why did you want it to be cheaper?
Why? Because it's higher. So you're paying for the same type of, okay, let me say it like this. You're paying up until age 100 for a policy, right?
Okay, so I'm paying for life insurance all the way until I'm 100?
All the way till you're 100 years old. Normally
from the age that I am, I'm paying it all my life.
You're gonna pay it all your life, depending on how the agent structured it and how they were structured. That's how they got 20 pay policies, 10 pay policies, but they're expensive. Different companies.
So the shorter, so if I have a traditional policy, the shorter it is, the more I have to pay.
Yes.
And then the longer it is,
the longer you pay.
The longer I pay, and it only benefit me when I die.
Yeah, when you die, you'll build a cash value, but not much.
But how? Okay, it builds a cash value. What is a cash value?
So a cash value is it's the money that the insurance company gives you,
okay,
or that allows you to borrow from your policy. So they say, hey, you took out insurance policy for $50,000. In year 3, you're going to have $500 cash in the policy. So now in year 3, you done paid, let's say $50 a month. So what's that? $600 per year. But so 600 times 3 is what? $1,800, right?
Yeah, $800.
And in year 3 is when you're going to have $500 in the cash value.
So the first 2 years, I'm just out of luck.
The first 2 years, you may have a few dollars, but year 3 is when you really going to see a difference. See something. But you put in $1,800, and in year 3, this is the key word. Year 3, you got $500 from the 18.
Okay. So traditional life insurance policies, the longer I pay, the smaller amount that I have to put in.
Yes.
And then if I want a shorter policy, I have to pay more. But traditional whole life policies, I want to make sure I'm correct. It doesn't accumulate cash value like that.
Traditional whole life policy.
It doesn't. It's not built for cash value.
Yeah, they're not built for cash value.
So what makes infinite banking different?
Infinite banking is built. So infinite banking is built minimizing the death benefit. And I hate to say minimizing because it's still going to maximize. But it's really the main component of it is the cash values, the living benefits.
So it's something like banking.
Yes.
It's built for banking.
Yes, built for banking. So you put in, for example, $10,000 the first year. Well, you ain't got to wait till year 3.
I ain't got to wait till year 3?
You ain't got to wait till year 3 to see a cash value.
Okay. I don't have to wait till year 3. How long do I have to wait? Is it like longer?
Well, if you put it in annually, right? You put in $10,000 annually. Once a year.
Once a year, okay.
Once a year. Okay, you may have $7,500 in cash value.
Okay.
Already, year 1. And guess what? After 30 days, and some companies allow you to pull it before 30 days, you can pull the $7,500 if you need to. But if not, you can let it sit there and accumulate.
That's a huge difference.
Yeah.
That's a big difference. I mean, waiting 3 years and then the policies that you structure through the companies that you're with, I can get my money within 30 days or less.
Yeah, 30 days or less, depending on the companies that, we set you up with.
So with this, you're saying, okay, I get the benefit of a whole life policy. I get that death benefit.
Right.
And I also have cash value that I can utilize for, like, let's say investments or anything like that to build my business, real estate, things of that nature.
Right. Yes. So, and that's exactly what you want to utilize it for. You don't want to put the money into a policy and then when you collateralize your death benefit, you're using your death benefit as collateral because you're borrowing from the cash value, right? You don't want to be using it just for anything.
So, so it's best for investing and not buying some brand new Jordans.
Exactly. Why are we going to do that? What we need that for? We want to create streams of income. We want to create more wealth.
So, okay. Still, somebody might not be convinced with infinite banking. Okay, you gave me the cash value component, but you're saying that it's built for banking.
Right.
How does it compare to a traditional bank? Because we seen like this year alone, we seen a lot of bank failures.
Right.
So what makes this better than having a traditional savings account?
Okay, so
help me with that.
I guess a few things.
Help me with that.
This is the first one
I got
a
regular savings.
So a regular savings account, one, your money is earning 0.01%.
It is.
Interest, okay? 0.01% interest. So I'm sitting my money in this bank. I'm going to give you a few components of it. It's sitting in the savings account. It's growing at 0.01% interest. So I'm not making hardly anything off of them utilizing my money and letting other people borrow it.
And then that little interest, like you were saying, I get the little interest.
And guess what? With that interest that you done made on the money that you have sitting in your savings, they're going to send you a 1099 interest form, INT form.
Yeah, I got taxed for it.
Yeah, and guess what you got to do with that form?
Help me out.
You got to file it on your taxes.
How many people filed it on their taxes?
Right.
How many people did that?
You had to file that on your taxes. So
the interest, okay, I want to make sure. So I have, let's say, I have $20,000 in a regular savings account. I have another $20,000 in the infinite banking policy.
Right.
The interest earned on the regular savings account, they're sending me a what?
On the regular savings, they're sending you a 1099 INT form.
And that interest right there, that little interest that I earned, now the IRS want their portion.
They want their portion.
But okay, infinite banking, do they want their portion? If I'm growing that money tax-free, do the IRS want their portion?
No, you don't pay taxes if your policy is structured appropriately. It has to be structured.
Okay, we're talking about the IRS now because Uncle Sam wants his. Hey, you're a tax professional, you know. What tax code? Like, is there a special tax code for this or anything like that?
For the infinite banking?
Yeah.
So 7702, 7702A. So you can look up those tax codes when it comes to infinite banking. So
there's a few tax codes that goes into like, okay, this is the reason why your money is growing tax free.
Right. And how it should be how it should be structured.
It got to be structured. Okay, I just can't go to a traditional life insurance company and saying, "Hey, I want an infinite banking policy."
You can't just go to anybody and tell them you want an infinite banking policy. One,
why is
a lot of them, they don't know the terminology. Two, they don't know how to structure the policy. It has to be structured a certain way.
So the company that you was working for when you were selling life insurance policies, and you said you met a lady, and she the one really put you on. You telling me that they wasn't structuring these policies?
No, they were not. No.
Okay. So, you have the traditional bank and you have infinite banking, and it's taxed. My bank. So what about, the bank failures came and a lot of people, like, they were saying when it came to their money being covered, they were saying like, only $250,000 can be covered.
I was going to hit that.
So, if I have over that in one policy, if I have over $250,000 and one banking policy, am I covered?
Yeah, your money is protected. Guess why?
Why?
It's life insurance. It's protected. So
help me out.
It's not if you have more than $250,000 in this policy, it's no longer protected like how a bank account is. You have over $250,000 in the bank crashed, you only insured for $250,000.
So if I got $250,000 in $1, that $1 gone.
Exactly. But you're only insured for that $250K and below. Insured is the key word. Banks deal with insurance. So therefore, why would I sit my savings in a bank account?
And is already not getting a lot of interest.
Exactly.
I'm being taxed on it. and it's not fully covered just off of those three things.
Right. Wouldn't I want to sit it in something that's going to protect it and grow it?
Tax free.
Tax free.
And I could, okay, if I want to use this money, can I use it tax free?
You can use the money tax free. Why? Because you're loaning it to yourself. So you are becoming the bank. And if you're an honest banker, you're going to pay yourself back.
They're going to loan you some money.
Right. If you're an honest banker, you're going to pay yourself back. You loan yourself $20,000. Okay, well, I might not want to pay it back right away the first year. But you know what? Maybe I'll do it over the course of the second year to the fifth year. So I'm going to divide those payments up.
Hold up. I want to catch this. So you said, okay, because I know in a traditional bank, if I borrow money from a traditional bank account, I have to start paying back like the month after. Yeah. I have to start. But you just said something. I caught that. I can hear. So you just said, if I borrow money, a loan from my infinite banking policy,
right,
I pay it back when I want to pay it back?
Yes, right. You pay it back when you want to pay it back. Why? When we get answers?
Why is that?
Because you're the banker.
I am the banker.
So who's in control?
Me.
You're in control. Guess what? When you want to borrow the money, do you need to show me W-2s or
for my traditional
tax returns?
I mean, if I want to go to my bank,
you got to show that, right?
Show at least 2 years.
Right.
I can't just say, hey, go my first year.
Right. But with your infinite banking policy that's set up for banking, you don't have to show none of that.
I mean, it done been times like, okay, I had the money, but they said, hey, your credit not looking too good.
Right.
So I mean, when I get this infinite banking policy, I'll be like, look, I got the money up in here. I got the money.
Right.
They gonna stop me from getting that money because my credit score, and this is not me. I'm just giving an example. If my credit score is a 400, can I get my money out of that policy to use?
Yes, you can.
Okay, help me.
It's not going by.
So it's not based off of credit score.
It's not based off credit score. It's not based off of your income. It's not based off of what your tax returns look like for the last 2 years. It's not based off what job you have currently. You tell your agent, hey, I want to pull $20,000. Okay, send the form over for you to sign. You'll have the money within 7 days. I say 7 days, 7 days, but it's much less than that.
It just shows. Okay, you said it's much less.
Much less.
So it shows that, okay, at me as a business owner, something like that is very beneficial because it shows that it's very liquid. So if I'm trying to get to a real estate deal or to fund my business, I can have that money like that.
Yes, it is very liquid. And that's how you want your money to be. Very liquid.
Man, I'm trying to tell you, I had trouble getting that equity out of my home.
Right.
Like how I own the home.
Right.
I done put money into the home for over X amount of years. And then I got to ask you, can I please get such and such? And then I got to see if I'm credit worthy, my funds is right. I know I got all this up in here in equity and I can't even touch it.
Right. And that's why it's so important, to be honest, to prepare. We at the age that we are, now people are at the age that they are now. But if you just prepare, okay, I'm not going to take my tax refund and spend $5,000 and $6,000 on shoes and clothes. I got these young kids right now. Let me take this money and put it somewhere where it's going to grow and increase and create a generational wealth for me and my family. So when my kids turn 15, 16 and go off to college, we got some freedom. We got some wiggle room because I done took my tax refund and I done put it somewhere that's going to grow for me.
Because I'm trying to tell you, if I knew about this when I started getting my tax refund, because I ain't gonna lie to you, when I used to get that tax refund, I used to ball, man. I'm coming out with the car. I used to have a 94 Camaro, had that thing painted. I wanted some 30-inch rims. I wanted that, but I was like, man, I ain't even trying to spend more money to get it cut. So I got the 20s. They was clean though. They was clean. You know what I mean? And I was doing my thing. You know what I mean? But back to you. I got caught. I got caught. But if I take that money and I put a portion of it into an infinite banking policy, I remember what you said. Whole life I have to pay, for a while.
Traditional whole life.
Okay,
traditional
help me out. How long do I have to pay this?
Okay. So with traditional whole life insurance, you can now, I want to be clear so there's no confusion. You can do a 10-pay policy, a 20-pay policy, pay to 65, pay to 85, or pay to age 100.
Right.
And there's probably others out there. Now, those are structured that particular way. So when you set that policy up, they're structured like that. With infinite banking, it's structured where you don't have to pay on it for the rest of your life. You can choose. So you can, I recommend to pay between 7 to 10 years.
So I can get me okay. All right, so I'm gonna ask you. So I can get me a banking system through whole life insurance, and it's tax free. It grows tax free. I can use it tax free, and I can pass it down tax free. Okay, and on top of that, I put my money in, and I only have to pay it. You suggest 7 to 10 years, and then I stop paying it.
Yeah.
Okay, when I stop paying it, does it still grow?
Yes, and that's so important. So you're going to put this money in for 7 to 10 years, right? Because you're going to put a good amount in, you know?
Okay.
Now, once you stop, let's say you stop at year 10.
Okay.
Just because you stop putting money in don't mean the policy stops growing. So the policy is going to grow until you die. But the insurance, it'll say to age 121.
It's life insurance.
Right, the mortality rate. So it's going to stop growing when you die, or until age 121.
So it grows
the cash value.
My whole life.
Yeah, the cash value will go, and the death benefit.
The death. So let's say I put in $15,000 that first year, and I'm healthy. And what would you say the minimum amount I would be looking at for a cash value like that first year?
The first year, so let's say you put in $15,000 out. The first year, if you're very healthy,
let's say easy math, 10,000.
Okay, 10,000. All right, I'm gonna go a little further. I'm gonna say 12.
Okay. In
the first year, at least I say at least 12,000 available to pull out.
For if it's 15,000.
15,000.
Okay, so that's all my money. I mean, that's almost all my money I can get back the first year.
We'll say 10 to 12,000, and depending on whoever it is I'm talking to, there.
So am I using am I using my money, or how does that work? Like I'm putting this money in into this infinite banking policy. Am I using my money? Did the money stop growing because I took it out? Like, how does that work?
So when you put the money into the policy, let's say year one, you want to borrow the 10,000 because you put in 15.
Okay.
Well, when you pull out the 10,000, what you did was you collateralized the death benefit. So your collateral that you had there is your death benefit, right?
Okay, yeah.
So what you did was when you pulled that 10,000 out, that $10,000 was the insurance company's money that you borrowed. Your 10,000 is, I'll say 10. Your 10,000 is still sitting in there growing.
So that's a big difference. That's a big difference between a traditional bank account, because if I have X amount of dollars in a traditional bank account, I pull that money out, that's actually gone.
It's actually gone.
And then it's not earning the same amount as I once was earning before I took it out.
Right.
And so, and then you said collateral?
Yeah, collateral.
So I'm collateralizing my death benefit.
Right.
So that means I'm using the insurance company's money, and I'm not using mine. My money stays in and it grows. That's good, because I have a death benefit, right?
Right.
And a traditional bank account, I don't have that, right?
Right. I'm gonna give you this as an example so people will understand what collateral is.
Help me.
So, for example, let's say I'll go to the bank and I need to get a traditional loan for $50,000. They may tell me, okay, we'll give you the loan for $50,000 because everything checks out, right? Mm-hmm. And then they may say, but we need you to sign your house over as collateral. Because if something happened and you can't pay us back, they need that because they're gonna take my home from me because I defaulted on the loan. So if in a banking, when you borrow from the policy, the death benefit becomes your collateral.
Because they know that it's a guarantee that you're going to die eventually.
Exactly.
So if I put in like $15,000 the first year, depending on my health, and I'm looking at least
for your death benefit? Yeah. Depending on your age, let's say you're 25 years old. You're looking at least $1 million death benefit.
$1 million?
$1 million. If you're 25. And you healthy, $15,000 per year.
So hold up now. Hold up. I'm 25 years old. Hey, if you're 25, man, you messing up, man. You messing up. Like she just gave you game. Like if I'm 25 years old, I have $15,000 to put into a policy. I can use the money, and it grows tax free. And you telling me I have a death benefit that at minimum $1 million.
Yeah.
And I basically, that money, like life happens, I have $1 million that I can pass down just by giving the insurance company $15,000.
That's right. You can pass it down. And this is what I wanted to say. This is what is important. I wanted to say this.
Okay.
When you collateralize the death benefit, right? And this is why we call it collateral, so you understand. When you borrow that $10,000, let's say something happened to you the first year, you pass. Well, the insurance company, all they're going to do is your loved one is still going to get the death benefit.
They still going to, yeah.
But they're just going to take what you owe them off of the debt. So if your death benefit is $1 million and you borrowed $10,000 and you had
$990,000.
Right.
I mean, you can't beat that. You can't beat that because I mean, I gave you $15,000 for $1 million.
Mm-hmm. And you borrowed $10,000.
And I borrowed the 10, so I still got all of my money.
Right.
I just used a portion of it before my death.
Right. Not only that, when you borrowed that 10, I would pray that you put it into some type of investment to create you another stream of income.
Not my Camaro with the rims.
Not your car, not shoes.
I mean, but you know. Okay.
Yeah.
Okay.
I would pray you put it in some sort of investment.
25, I might. Okay.
Invested into the business to, allow the business to continue to grow somewhere where you're creating that stream of income or making it stronger.
If you're 25, you need to become more responsible. I mean, you just gave some game right there.
Yeah.
Like, cause it's a lot of people. I know when I was 25. I didn't have my hands on money, but I never knew what to do with it. So I'm just buying clothes and shoes.
Right.
I'm just doing my thing. Yeah, I'm just doing my thing. Mm-hmm. I never thought of, I never was taught about money. Mm-hmm. So my mindset was different.
Right.
So it's good to notice, and hopefully somebody that's 25 or is it a certain age? Like,
what
if I wanted
you could be 18.
So what if I wanted for my child?
You can get it for your child. That's when you want to start. If you have children, put it on your children.
Is it beneficial?
Very beneficial, because guess what? There are people that get these policies, right? Created for their children and grandchildren. And guess what they give them to them as?
What?
As gifts. When they become of age.
So they give these out as gifts.
As a gift. When they go to college, here you go. Why is it a gift? They didn't put.
And they set for life.
They set for the rest of their life.
So they'll create a policy. So you telling me it's family members out here that will get these policies structured a certain way. Mm-hmm. And they put in X amount of dollars. Mm-hmm. And then they will stop paying on it. This child probably 7 to 10 years old.
Well, with children, you can pay on it. If you want, it depends on how much you do, because with a child, they only can have a certain amount of insurance based off the parent. Mm-hmm. So that's why it's important to make sure you're taken care of.
Okay, that's
before you go and I'm just going to put insurance on my child. It don't work like that because it's a red flag. Why you not protected? Why you not insured?
Okay.
So first and foremost, you got to be protected, but for your child, it's based off what you have on you. It's a certain portion they can get, but you want to, if you can afford to, and do whatever that amount is on the child that you can afford. You want to do that for a number of years. You can do it longer than 7 to 10 years because it's a child. They're younger. So it's gonna.
So they're really so young. Because, like you said, the younger I am, how does that work?
The younger you are, the faster your policy is gonna grow, and the larger it's gonna grow because you're so young. Okay.
So it grows, but because you have, I'm hearing about the IULs. Mm-hmm. What is the difference between what you do, how you structure policies, with the whole life? Mm-hmm. How is it different than a IUL? Like, should I put my money into a IUL to create infinite banking or a whole life? Which one do you suggest?
I suggest whole life. Why? Whole life is guaranteed. Very important.
Guaranteed?
Guaranteed. IUL is based off the stock market. So if you want an index universal life insurance policy that's going to go up and down, up and down, I want my money to be guaranteed. I want it to grow for me continuously.
Right.
I don't want to have to see, I'm at 20K today and tomorrow I'm at 10. I don't like that. I need my money to constantly increase. I want to practice what the rich practice. Okay.
So the wealthy.
Yes.
So one thing, I spoke with a guy and he was like, yeah, you have the potential to earn more than a traditional whole life. He said, yeah, traditional whole life, not traditional whole life. I said that wrong. The infinite banking policy that's structured with the whole life. He was like, you only get at most like a little over 5%. He said, but with this, you can get like, let's say he said
with an
10.
IUL.
With the IUL, yeah, with the IUL, he said 10. I said, okay. And then he said, and you don't have to worry about you losing money because it has a 0% floor. I said, hold up. So you telling me if I don't if the market, something go wrong with the market, I don't have to worry about losing. He was like, yeah. So I was like, okay, if I made $0 that year because of the market, I lost. Mm-hmm. I lost because if I have a whole life policy and it's earning versus my IUL, that's taking that loss, and I know that IUL, it got the fees, right? It got the fees, so I didn't make any money, but this policy, I'm paying for the insurance in it, right?
Right.
And what is it? It's continually.
So, all right, let's back up a little bit because you gave me a scenario. With the IUL, it's based off projections. So they're projecting, hey, it's going to grow. It could grow 10% this year.
So it's not guaranteed.
It's not guaranteed. It's based off a projection. Do I want something based off a projection? Do I want to go work a job? Let's say I go work and they say possibly you can earn an extra 10% this year. No, I want a guarantee. I want my money.
Yeah, if I'm at the job, they be like, yeah, you possibly can earn $1,000 this week, and then I only seen 4.
No. I don't want that. I want a guarantee. I want a guarantee. So whole life insurance provides me guarantees.
So that's very beneficial in growing my money, because in a traditional banking system, like, I don't want where I put my money into a savings and then 1 week is 1,000, the next week is 5. It's built. So this is built for having your money safe, and it gets that growth, and you're not chasing after percentages.
Right. We're not gambling. I hate gambling. I don't like that. I don't want to, I don't like gambling. So that's why IULs, they are not what you're looking for if you're trying to create generational wealth, and especially if you're trying to create generational wealth and become your own banker. You can't become your own banker with an IUL. Why? Because it's not guaranteed. It's not guaranteed. Like, how can you become the bank and you have no guarantees?
Right. They don't go off of that.
Right, exactly. Banks don't. Their money doesn't grow based off the stock market.
So
you can't become the bank.
Okay, so all right, what is it that, okay, you telling me to become the banker, so I need to act as the banker.
Yes.
What is it that bankers mainly put their money in? Like, do they put their, like you said, loans and like, okay, loan is part of becoming a banker. Right. I know they give out a lot of loans.
Right.
And like, okay, do they put more money into like real estate or like what do they
insurance, life insurance.
Hold on, what?
Life insurance. The tier 1 capital is life insurance.
Okay, help me out with that. So you're telling me banks put more money into life insurance than into real estate, credit cards, loans, stocks?
Yes. So the banks sit majority of their money in life insurance. Life insurance, like we were saying, whole life insurance, is guaranteed. It's going to grow.
Okay.
So yeah.
So what, like, is it something that, is it a terminology for it or something like that? Like, what is it called? You know, that banks sit their money in. I seen that they had like different terminology. I seen like Coley, Bowley, like.
Oh, okay. So bank owned life insurance. So what is what it's called?
What is that?
So it's when the bank owns.
Is that the Coley?
It's Bowley.
Okay, Bowley. Okay, so what is that?
So bank owned life insurance is when the bank owns the policies of their key employees. That's how I say it like that.
Okay.
Key employee insurance is when, you have. Okay. So yeah. So okay. Yeah.
Okay. So you said the company owning life insurance, that's when they have it for the key employees, and then the bank owned life insurance, that's when they're putting money in to protect the bank.
Right.
Okay. So we've been on infinite banking for a while. I just want one jewel from you for infinite banking.
Okay.
How can this help real estate investors?
Infinite banking?
Because I mean, like, when I look at real estate investors, they make a lot of money. And they need their money, and you saying that it's liquid.
Right.
So okay, they're putting that money into a traditional bank account, and they could be having over $250,000 in there. So they got it in there, and then you're telling me the interest earned on it is hold up, y'all. Let me put this charge in. Before we die. So the money earned on it is taxed. So that's not helping a real estate investor or a business owner.
Right.
How does it help them? Like, how does it help them when it comes to, like, is it helping them in a way where their money is not being lazy or anything in those, like, if I put it in a bank account instead of an infinite banking instead of a bank account?
So if they put it in the infinite banking policy with a real estate investor, they have the opportunity for their money to be liquid, to consistently grow. So they got that guaranteed rate that their money's going to grow. It's not sitting in the bank where it only growing at 0.01% interest. So the best way that I can explain this is like a house, right? So you can't purchase a home without having insurance. So when a real estate investor purchases an infinite banking policy, they're able now to increase their wealth continuously because they get to recycle money. So let's say, for example, they create a policy. I'm going to give this example. Let's say they put $50,000 in the first year. Well, they may see a property and they need to put $40,000 into the property the first year.
Right.
So they get to go to their policy and pull that $40,000 out the policy, right?
Right.
And put it into the house. Let's say the house, once they put the 40 in, let's say they went and sold it for 80. I'm just throwing numbers out there. Well, they sold it for 80, but guess what? They did it within the same year, for example. They can actually go take that money, put it back into their policy, and recycle and do the same thing again.
So the money is basically earning money on top of what they made. So they invested and made money on the home.
Right.
And then when it's in the policy, because you said I'm using the insurance company's money.
Yeah.
So I'm making money on that end too.
Right, exactly. So they collateralizing the death benefit using the insurance company's money to keep growing their stream of income that they have.
So I'm my dollar is working for me twice as hard.
Yes. Yes. Because it's not sitting in the bank account where it's just sitting and you go, because once you spend the money, it's gone.
And I got the death benefit.
Right. You got the death benefit within the policy. But once you spend the money from the bank,
right,
it's gone.
It's gone.
You can't get it.
I got to build it right back up.
Yes. If I buy a house, they say you got to put $20,000 in, and I give them my $20,000 cash that I have in my account. Well, it's gone. But if I had that same 20 and I put it in my policy, then I went and borrowed it from the policy by collateralizing my death benefit, I still got my $20,000 sitting there. I'm just giving them the insurance company's money.
And then if the deal like take longer than usual, is okay because I'm still earning over here on the other end.
Exactly.
And then, like you said, if I get a traditional loan from a bank, and the deal doesn't turn out like it need to turn out, I don't have to pay back immediately. I can just
No. From a bank, you do have to pay back immediately.
Yeah, right. But when it comes to the infinite banking policy, I don't have to pay back immediately.
Right.
Let me get myself together.
Exactly.
I can pay.
Yes.
Is it a certain amount that I have to pay?
No.
I pay back
You pay back how you want, when you want. Why you
so
want
it just takes a lot of stress off.
Yes, because you're the banker. You're becoming the bank. So you have control.
I got that traditional
you have no control.
I'm in trouble.
One thing that people need to remember is you want to have control of your money. That's the main component. Why do the bank have leverage over you? Because they got control of your money. Your money is in their bank and they're utilizing it for someone else to borrow. They are in control, not you. They give your money to who they want to have it.
And they making a killing.
They're making a killing times 10, times 20 of whatever you sitting in that account.
And
plus the interest they charge them.
And then not even giving me pennies.
You don't get nothing for that. You're getting 0.01% interest, if that.
And the infinite banking, I'm getting, and you said it was what? Like, how much am I earning?
With the infinite banking,
minimum amount,
a minimum 5% interest a year.
Versus, it's better than
on top of your death benefit growing. Yeah.
So
and dividends. Don't forget that. Your
dividends. What is a dividend?
A dividend is when your policy, it has to be with a mutual owned
company.
Yeah, life insurance company. A mutual owned company. If it's not mutual owned, you're not getting dividends, okay?
Okay.
So it has to be a mutual owned insurance company. So what happens is it's based off how well the company performs. This is some extra.
So you got to make sure you're with the right company.
Yes, you got to make sure you're with the right company. That's what we're for.
I can't just go to such and such down the street.
You sure can. You can't just go anywhere and say, hey, I want to get this type of company right here. I mean, this type of policy with this type of company. It don't work like that. You have to make sure you're with a mutual owned insurance company. Has to be mutual owned. If not, you're not getting no dividends.
All right, so I have invested in stocks before, especially during the time of COVID. When 2020, I was like, man, I'm about to get it in. I'm about to make this money and I'm about to become rich. I'm about to get it in. So I put my money into, I remember it to this day, I put my money into a company called Energy Transfer, something like that. It was ET. So I put my money in this thing. Guy told me, he was like, yeah, put your money in this, man. You're going to get a lot of dividends. You're going to make X amount of money off of this passive income. You ain't got to worry about nothing. So I'm like, okay, I'm feeling good. I'm like, man, next year, this time, I'm looking good. You know what I mean? I'm up there with the big boys. So make a long story short, when it was time for the dividend payout, let's say I believe it was like 60 cents per share. When they did the call, they was like, yeah, dividend payment was 60 cents per share. Now it's 20.
Right.
They cut the dividend. And I had to report this thing on my taxes.
Right.
So Is this the same thing with infinite banking?
No.
Like, okay, help me out. Help me help you.
With a mutual owned insurance company, you are part owner of the company. So that's why I say mutual owned. So the policy holders, the policy holders, which would be you, me, whoever has a policy, become part owner in the company. So it's based off how well the company performs. So because the company invests their money in safe investments, I'll say. So, then, they're going to grow. They're going to have those dividends. They're going to have those dividend payouts.
So they don't miss.
No, I haven't seen it. One particular company missing over 145 years.
Okay.
So I haven't seen where it missed that. They have those dividend payouts. And that's something extra. That's not like your policy just isn't determined by the dividend. The dividend is on top of your guaranteed payments or
so that you get the interest. Rates. So you get the interest,
your guaranteed cash value, basically, because that's going to grow guaranteed.
The interest, the dividend,
and your death benefit.
The death benefit. Mm-hmm. Okay, so does it also do it also get compound?
Yeah, I was about to say that. Yeah.
Okay, so
so you got interest, you got compound interest, you got your death benefit, you got your dividends, all these components into this policy.
And every single component, is it tax free?
Yes, it's tax free.
Okay.
Now I just want to go back a little bit. So compound interest, you know what compound interest is, right?
I mean, I know a little, but can you tell me, like, okay, what's the purpose of it? Like, is it important? Like,
yes.
Okay, help me out.
Compound interest is very important. So, a penny a day compounded for 31 days is close to $11 million, right?
Hold up, what?
A penny a day compounded for 31 days.
So can I Google this? Like, if I Google this right now, it's going to say that a penny compounded 31 days is how much?
Close to $11 million.
So, okay. All right. So now you got me back to, I'm feeling good now, I'm feeling like I'm about to, I'm that dude 2020. I'm about to put my money up into the stocks, but it was a lot of risk with it. I want to make sure, help me out. Does this policy compound daily?
Okay. So now, I told you
I'm about to make some money daily.
Hold up. So I told you what compound interest was, right?
Okay.
So what happens is it doesn't compound daily, but it compounds annually, meaning once a year.
Okay. And this is all tax-free.
All tax-free. So you're not going to find a vehicle that's going to give you compound interest, the death benefit, guaranteed cash value, and interest and dividends.
And the dividend. I get
all these components.
Because I didn't own CDs from the bank. I didn't had those, and it did not have a dividend with it. I just got the interest.
Right.
I didn't had a Roth IRA, and let's not speak on that. It was like a cap to it.
Yeah, it's a cap, right? You only can put but so much money into it per year.
So is the infinite banking like?
No.
So I don't have no cap.
It's no cap. Now it goes based upon your income, right? But there's no cap. There's no infinite banking policies. You only could put a maximum of $10,000 per year. There is no cap. The bigger your money, the longer your money, the more policies you can have.
So I'm Elon Musk, right? I'm Elon Musk.
Yeah, you don't have enough money for it.
So you telling me if he put in, let's say, $1 billion, he can put in $1 billion a year if he wanted to.
If he wanted to, but
you're saying that, but you did say like banks, we're becoming the banks, and this is something that they do.
What you saying?
Like, is it a limit? Is no limit?
There is no limit.
Okay.
But yeah, if I'm getting technical with things, it's based upon your income.
Okay. So
But there is no limit. There's no limit.
That I like that, because you have people that has they have the traditional 401k, the CDs, the stocks. You name it.
Right.
They have those things, but they probably never heard of infinite banking.
Right.
And then somebody might say, hey, I'm still making such and such. off of my stocks. I'm making a lot of money off my stocks, but they missing that, okay, you're going to be taxed.
Right. You're going to be taxed, and then you making money today, but what are you making tomorrow?
And then it's like, okay, they be like, okay, but I went to my bank, and so I can skip over the taxation, I loaned the money or whatever, X amount. Mm-hmm. But from what you're saying is, okay, you still missing that death component.
You missing
with the 401k, the stocks, yes, everything. You missing that death component.
You missing the death component. And then speaking on 401ks, that's a whole nother topic. But
would it, like, help me out? Like, what do you mean?
So with 401k, one, you right now you got your 401k, you paying on it through your job. Mm-hmm. But then I'll tell you, when you're 65 years old, let's say you start drawing from your 401k, you still have to pay taxes. Uncle Sam still wants their money. You're still going to pay them in your retirement.
Hold up.
And it doesn't have a death benefit.
So, okay. So when I retire, mm-hmm, I still have to pay taxes on the 401k.
Yes.
Even though I'm retired.
Even though you're retired and you didn't work 40 and 50 years and put all this money in here, you still have to pay taxes. It is not tax free. So when you at these jobs, and you're signing up for these 401ks, they're not tax-free, and they're based off the stock market. They go up and down.
Man.
You can't pull the money out. You don't have control of it. This is important. A lot of times people don't understand. You got a 401k, let's say you got $15,000 in there and you want to borrow it. You cannot borrow it just because you want to borrow the money. It's a particular reason. I want to say it's about 6 or 7 main particular reasons that you can pull the money out. You cannot just go in there and pull the money. And now you could do a loan, but when you do the loan, I want to say with the loan, there's stipulations when it comes to the loan.
Do I have a certain time period that I have to pay the money back?
Yeah, well, with the loan, you got to start paying that back immediately, I believe, with the 401k.
I don't want it.
Yeah, 401ks, I would not advise, a 401k. Infinite banking.
So it really doesn't, like, I'm not a tax professional, and I do have some other questions for you to lean towards, because I know you do taxes as well, and you just don't do infinite banking. So the way it sounds, it really doesn't benefit me to get the tax benefit from a 401k, because I'm being taxed heavy later on money that accumulated.
Yes, you are being taxed heavy later on money that's accumulated. And I do want to clear this up, because I naturally talk this way, but with the 401k, you can take money out or you can loan money out. So when you loan the money out, you're going to have to start paying that loan back. You just can't go and take money from your 401k. You have to have a particular reason why you're getting that money out of that 401k.
Okay, so all right, let's get to the tax side of things. You've been doing that for how many years now?
For taxes, I've been doing taxes for 11 years.
11 years. So let me ask you this. When it comes to real estate, what are some of the big misconceptions when it comes to, like, taxes? Okay.
So when it comes to taxes, like tax preparation, or
what are some of the big missed opportunities that a lot of people have when it comes to real estate investing? Like, real estate investors, what is something that can really help them, like, in their investing? Like, what's something like that you experienced, that you've seen, that real estate investors miss?
Depreciation.
Okay.
So depreciation is when you have an asset. For example, let's say you're a landlord and you rent properties, for example. So let's say you have a home, right? And with that home, the IRS says, hey, this home is worth $200,000, not the IRS, but, with the area that you're in, the house is worth $200,000. Well, on your tax return, you can depreciate that asset, meaning you're writing it off, for lack of make it real simple. You can write it off. So you can deduct a portion of that home every year on your taxes for a number of years.
So how does that help me?
Because what it does is when you take depreciation, so let's say your taxable income is $40,000. And when I say taxable income,
money I owe,
money that the IRS says, hey, we're going to tax you on it. So, for example, simple math, let's say it's $40,000, right? $40,000 is what the IRS is going to tax you on. So let's just say for simple math, your tax rate is 15%. So they're going to tax you 15% times the $40,000 that you made. Now, when you have depreciation, when you have an asset that you can depreciate, let's say the house is worth $200,000. Let's say year one, you can depreciate $20,000. Well, when you take that depreciation and subtract it from that $40,000, what are you left with? Can you tell me? $20,000.
Okay.
So $20,000 is what's going to become your taxable income. So now they're going to tax you on that $20,000 times 15% instead of $40,000. So you just saved $20,000 on taxes.
Oh, okay. So that leans into,
or you reduce your taxable income by $20,000.
So now that leans into my next question. I was about to ask you, like, why is it important for me to have a tax professional like yourself, like an accountant, or because I know you do bookkeeping? Like, I'm a real estate investor or a restaurant owner. Why is it important for me to utilize your service?
It's very important because a lot of times you're not educated on credits and deductions on things that you can do in your taxes, right?
Okay.
You're not up to date with the laws, with the knowledge, or any of that. So when you come to a professional like an accountant or a bookkeeper or someone like myself that's knowledgeable in many different areas, I'm going to help you to save money on things that you have no knowledge of because I'm skilled in this area. So for example, you may be a restaurant owner and you may be a landlord. Okay, so and then let's say you've had somebody do your taxes, previous years. Well, they never depreciate your real estate.
So I'm missing out on that.
They never depreciate your property, so you're missing out on that. You got a vehicle that you use for your business. Only for your business. You got two vehicles, one for personal, one for business. That hasn't been depreciated. You haven't even you didn't write the miles that you drove or anything. There's so many different components when it comes to business owners not taking proper deductions.
Okay, so basically you're saying like, okay, I done made X amount of dollars this year, and because I didn't have a tax professional like yourself, because I didn't utilize you, I'm paying the IRS more money than I really have to.
This is the best way I'll say it. Because you made more money this year and you did not, because tax preparation is the last step, right?
That's different than tax planning?
Yes, it's different. So when it comes to tax planning, you can't come to a tax professional and expect tax planning in April or March.
Okay, so tax planning, and then you got tax preparation. So tax planning, is that before or after? Like, is that for something that's for the future, or
yes?
How is
tax planning is what you're going to do to plan for your future. So let's say right now we're in the month of July, right?
Right.
So okay, now if you haven't already, you want to start tax planning because you want to strategize. Hey, I'm on the verge of making an extra $100,000 this year. Okay, well, do you want to pay Uncle Sam?
At least 30% of that.
Right. You're gonna pay that
$30,000 for that.
Exactly. So therefore, what you want to do is you want to find a trusted accountant, someone that specializes in bookkeeping, tax planning, tax preparation, so that they can help you strategize and tell you, hey, this is how you can save on taxes legally.
That makes a lot of sense because, man, I have people that I done spoke with. They was like, man, this person, she's a tax professional and she charging me $10,000 a year. Now, understanding what you're saying, I'm going to give up the $10,000 a year every single time if you're saving me at least $30,000.
Right.
Like, I'd rather pay you 10 than paying the IRS 30.
Right. A lot of times people don't understand, if I go work for a corporation, they're going to pay me 6-7 figures to work for them. I'm an accountant. I've been in the game a number of years.
If you work for me personally, right? That's what you're saying?
No, if I go work for a corporation, a company, I'm just giving you this right here. This is important for people to understand. If I go work for a corporation, they're going to pay me 6-7 figures a year. So your accountant charge you $10,000 1 year, $10,000.
That's nothing.
Nothing. That is pennies. For the amount of work that they do. Do you understand what they do?
Yeah, I had told a person when I was they wanted me to do some work for them. And they was like, hey, I want you to teach me marketing and money management and things of that nature. And then I had told them my fee.
Right.
Let's just say the $10,000, which is not.
Right.
I had told them my fee. And I said, would you work a job for $10,000 a year?
Right.
He was like, nah, I wouldn't work a job for $10,000 a year. I said, why? He said, that's not enough money to support my family.
Right.
That's not enough. I said, that goes the same thing for me. You know what I mean? Like, that's not a lot of money compared to if I worked a job. Like, I can work at McDonald's, make $15,000, $20,000, but you want me to do some work to grow your business for $100.
Right. A lot of times what people don't understand is, for example, your accountant is really the bread and butter to your business, just like your advertising, right? So your accountant is the most important component. Why? Because your accountant knows how much you make, where your money is coming from, where it's going. And if you have a good accountant, your accountant's going to know how you can save wherever you're lacking in. Okay, hey, we can do this right here to help you. You know, your accountant is working extremely hard for you. Like, it's so many components to what an accountant does. You know, bookkeeping is a basic term for things that an accountant does.
So is it like a lot of people say, hey, you know, bookkeeping, I'm just plugging in numbers.
No, like, you're not plugging in numbers. Like, you can get a software if you want to, and you ain't plugging in nothing. You have to understand.
I got QuickBooks.
You got QuickBooks, but you don't understand it. You just clicking buttons. You have to really understand what it is that's going on. You have to understand how to read those reports, that profit and loss, your statement of cash flows, your balance sheets. You have to know what those things mean to know what your company looks like financially.
I don't know. I just know marketing.
Right. Your profit and loss statement is going to show you, okay, hey, this is your income. These are all your expenses. And then here below, this is what your bottom line looks like.
So it's basically like you take away that burden of like, hey, just stick with your expertise.
Yes.
And this is my expertise, and this is how I can help you not only save but grow your business.
Yeah, you definitely.
I'm paying that $10,000 every time.
Yeah, you should definitely stick with your expertise. Why? Because your business is going to grow faster. Hire the person that's going to get the job done. Okay, I need somebody I can trust that's going to make sure that financially I'm educated and that my business is running how it's supposed to run. So why wouldn't I pay for someone to do? Why would I want to play that position?
So, okay, this goes into my last question in this area.
Mm-hmm.
How big do you feel like a person's mindset play into not wanting to pay a professional like yourself, like what your value is? Like they'll say, hey, it's too much.
Right.
Because they don't understand the value in what you do and what you can provide for them.
Right.
How big of the mindset play in that?
The mindset is the major factor in it all. Okay. Mm-hmm. It's in anything we do, but the mindset plays the most biggest part. Why? Because if you think small, your business is going to be small. You're going to get small results. You have to start thinking different. You have to really think, okay, how do I want, is this something that I'm creating to continue on growing, or is this just a hobby? Is this something I'm just doing for now? Is it something that you're serious about? You know, that's what you have to ask yourself. And if so, why are you trying to play the role of the accountant when you don't know numbers? That's it. You don't understand numbers. Numbers is not your thing. You understand, okay, I'm a nurse. I know how to go and I done created this practice. So I know how to run my practice, but I don't understand the financial side of the business. So let me find somebody I could trust. I can't express this enough. Let me find somebody I can trust that's going to look out for my best interest while I'm running my practice.
My mindset is holding me back from growing.
Yes, your mindset is like the most important thing when it comes to your business. If you can't change this, you're going to be stuck. You're going to be in a cycle where you're trying to figure out, how do I get to the next level?
So give me a jewel on how can I improve my mindset?
How can you okay, one, you have to open up your mindset. A lot of times the reason why we have issues with our mindset is because we were taught something and you run with it and you don't think that
I have to change.
Right. You learn something and you stop learning. You have to stop learning. Okay. You have to continue to learn. Right. When you close your ears up, you're gonna stay stuck. So you have to, when I came to the business, I had to understand. I already understood this because I was in the world and I worked for different companies. Okay, it's just so much that I have to learn. So let me see. Okay, I got to do this different. I can't think like this, because if I think like this, it's gonna be like this. And then I have to think bigger.
So all right, okay. My mindset is open, but how do I know to trust you? You know, with my financials to grow, like, okay, like what actions?
Actions speak louder than words. So someone's come to me. I have a lot of clients that come from terrible relationships with other accountants, right?
Okay, yeah. Okay, I didn't have that bad relationship.
Yeah. In order for them to trust me, what
makes you different from them?
What makes me different is, one, I'm about my business, and two, I want to see you prosper, right? So my goal is to make sure that we are on one accord. I have to make sure we're on the same page. Why? Because if we're not, if you think one way and I think another way, we're not going to, we're not going to be able to come together and understand what's going on with, with the business or anything. We're not going to get along. So the main goal is to make sure that me and you are on one accord. So once we had that conversation and we're on one accord, then
are you a good communicator?
Yeah, that's what I wanted to say.
Because I done had a bookkeeper where I done went, 3 years, they behind, and with my bookkeeping, right. I was paying them, and I only can hear from them like once a week. Like, are you that person?
Right.
Like, when can I speak to you?
Okay, so with my clients, this is what I ask them for. One, you have to trust me, and two, you have to answer your phone. And I said, so
you meaning I'm gonna be receiving calls from you.
You're gonna be receiving calls.
So I ain't got to worry about calling you.
Right. And I'm sorry, it's one more thing. You have to meet with me monthly. It's not an option. You have to do this.
What are we meeting monthly about?
I'm about to tell you. I need to show you what your company looks like. I need to show you what your profit and loss, where you stand at each month. I need to show you your balance sheets. I need to show you a statement of cash flows. I need to show you all these things and to provide my detailed analysis and report to you so that you can see what it is that you can do better in the company, or are you on track to meet your goals that we set when we met.
I like that because just like, okay, I'm a real estate investor, and if I'm purchasing a property, I have someone to evaluate that property, to see, okay, what issues it may have and everything, to know, okay, what I'm getting into in order to see how much profit I'm going to make and how long it's going to take.
Right.
So just like what you do, you checking out that business and saying, okay, what the profit is like, how long it's going to take to achieve the goals, things of that nature, right?
Right. That's exactly what I'm doing. So you trust that appraiser or whomever to go through that house and tell you what everything is like and what everything is doing. That's the same way you want to trust your accountant.
And they don't try to do all the jobs.
Exactly.
They don't try to be the contractor.
They can't be all the jobs. You got to have the skilled electrician.
The plumber.
You got to have a skilled plumber. It's certain people
the designer.
Exactly. You can't be all those things. It takes special people to do that. They can try
to be up, but it's going to take them even longer to get the job done.
It's going to take them longer. So what that mean? What that mean? If it take you longer, that means you're losing more money. So what do you think it means when you're doing your own books or
I'm
financials.
doing my own books.
It's gonna take you longer to get to your goals. You filing your own taxes, missing out on deductions. This is the biggest thing I see with business owners.
Okay, have you personally have any clients missed out on depreciation?
I've had hundreds of clients miss out on depreciation on so many deductions.
So give me an example of a client. Like, what was the most money you helped a client? If you can say it, what was the most money you saved a client in taxes? Like, if they didn't understand the taxes,
right,
and like their deductions and credits, did I say that right? Deduction. So if they didn't understand, these tax credits and deductions, what client you like? Okay, I would have owed, let's say, $100,000. Yeah. But if it wasn't for her,
okay, so I had a client that owed, I want to say it was like over $130,000. It could have been more, but I'm gonna say 130. It's probably way more. Okay. But I'm gonna say 130,000.
And was there a business owner?
They were a business owner. Okay, now when we were finished, once I really had to analyze everything that they had going on, of course,
And they owed 130.
130,000. Okay. When we were done, the IRS owed them 3,000. Now, not every business.
Hold on, what?
I said, when we're done, the IRS owed them $3,000.
So they didn't owe the IRS.
They didn't owe the IRS. Now, not everybody is not entitled to a refund, but this particular business, because of the certain things, and they didn't have to owe the IRS. We was able to save them $100 and some thousand on their taxes.
So it goes to show, and the importance of having a tax professional like you.
Yes.
Because if I would have prepared my taxes by myself,
right,
not knowing these tax credits, not knowing these deductions,
right,
I would have been on the IRS over 6 figures.
Yes.
And that same mindset that I would have had that year, I would have took it to the next year and owed them another.
That's right. It's going to be a repeat cycle.
I'm paying the $10,000.
Right, exactly. It's just so important, Me, if I'm not a seamstress,
you crazy if you don't.
If I need a garment, I'm gonna go to the seamstress and have her to sew it. You're not gonna
sew it yourself.
I'm not sewing it myself. Why? It's gonna take time for me. I got things to do. I'm gonna pay the professional to do it so that I know it's done right. That I can put it on with ease. I'm not stressed out trying to figure out how to do it. I ain't gotta go on YouTube and how do I do this? YouTube don't give you all the details. So therefore, I'm gonna take it to the professional to get it done for me.
Right. So I have one last question.
Mm-hmm.
What is it that you can give to, like, what jewel can you give to business owners or real estate investors like that they can utilize today? Like, what's something like, because they might have that mindset of, I really don't need you as a bookkeeper. I really don't need you as a tax strategist. What's a jewel that you can give them to help them open their mindset? Okay,
something that I can give them to help them open their mindset. This is what I would say. I don't know if this is a jewel, but this is what I would tell them. You just have to change. You have to shift your thinking. If you want to be the accountant, how can you be an investor? How can you really say that you're a real estate investor? If you're running multiple positions, one you don't really know about being an accountant, right?
Mm-hmm.
Why is it that you want to, what's the word when they say, is it gyp? When you're trying to get by on something.
I'm not sure. They just, I'm not sure.
I'm going to say gyp. I can't think of the word, but why do you want to pass by?
If you know the word, please put it in the comments, because I'm not sure what she... I never heard that word, gyp.
I might have made it up. I don't know.
Yeah.
Why do you want to get by, slide by the accountant?
Right.
And you do it, and you want to be the investor, you're going to lose money somewhere. So just because you think you're saving money by doing your own bookkeeping. You're truly not. Why? Because it's taking time from you from being that real estate investor or that landlord or whatever business that you run is going to take time from you because you're trying to figure out these numbers over here.
You're right. Because it makes sense because I'm a landlord. I'm a real estate investor. I have, buying whole properties. I'm not going to let my tenant slip by and only pay me half of the rent. I want what's owed to me.
Right.
I provided you a service. I gave you value.
Right.
You're staying in a home and you want to just give me what you want to give me.
Right.
It doesn't make sense.
Right. Yeah. So the best thing I could say is, and I don't know why I want to say jip, but yeah, definitely
you can use get that what word, you pay for. Please let her know what that word is. I really don't know. Help me help her.
You get what
I'm
you pay for. I'm not good with
definition.
That's what you get what you pay for. So when you want to be cheap, you're going to get cheap results. You want to pay for someone that you trust. I can't stress that enough. You want to have a trusted professional, someone that you trust, someone that you see, okay, she's getting the job done or he's getting the job done. They know what they're talking about.
Because a lot of people want cheap and fast, and they want it good.
Yeah.
They want cheap, fast, and good.
Right. You expect me to just do anything. No. That's not who we are. That's not what we do. What we do is we're going to be accurate.
See what the thing is? People get so caught up in the McDonald's mindset.
Have it your way.
They want to have it their way, and they want it cheap, fast, and good.
Yeah,
but you're not McDonald's.
I'm not McDonald's. I am not. So if that's what you're looking for, you won't find that here.
You didn't pull through the wrong drive-thru. So that's I truly appreciate you. Giving us some value. Okay. And do you have anything that you would like to end this off with?
No, I think what you asked me previously about the mindset for them, that was like the most important thing I would want to say, and I do want to say this. I know, we talk about bookkeeping, but bookkeeping, and bookkeeping is it's way more to bookkeeping than it sounds, but bookkeeping is the most important pieces in your business. That's the biggest part in your business. Bookkeeping shows you how you're actually operating. Okay. It is just so important. So don't try to, I'm just going to do this myself and just plug something here, plug something there. You really are hurting your business because you're not able to grow. You can't grow properly winging it. You can't grow winging it. If you're serious, if you're trying to create something for your children, being if you're saying you're doing the books and you don't know what you're doing, you need to hire a professional.
So have the right people on your team.
Have the right people on your team.
Because Michael Jordan did not win the championship without Scott and Pippen. LeBron James did not win the championship by himself.
Right.
It was no man that had won a championship by themselves. They might say Mike Tyson, but even he had a team behind him.
Yeah, it takes a team.
Serena Williams, she had a team behind her. It takes a team to win.
Right. One more thing, I do want to say this. It is important when you make decisions to talk to your accountant. Like, I don't understand this, how just people don't do this.
Don't spend.
Stop making hasty decisions. Stop going out there. I'm gonna buy a car today. You're making your decisions based off of an impulse.
Might did it improper.
Yeah, you went and bought a vehicle and you could have bought that vehicle a whole nother way and saved them taxes this way. It's just so many different components. But when you see these Donald Trumps and these other people, when they make these financial decisions, they don't, and you see he burned an ex-wife on a funeral plot.
It was on the golf course. It was on the golf course.
Do you think he just came up with that out of his head?
No. So he ain't do it out of hatred.
No, that man.
He ain't do it out of hatred. Like, I'm gonna just roll this thing all up on her.
It was a strategic plan. Okay.
That was a tax strategy.
Yeah, a strategic tax strategy. Okay, so when you make decisions, especially when it comes to your financials. Now, your home decisions, that's between you and your spouse. Y'all make those decisions. But when it comes to your business, you definitely should seek out advice from your accountant. That's what they are there for. They see your numbers. They see how your business is operating. This is the biggest flaw I see in a lot of small businesses. You know, when we up and coming or we already established, you're just making decisions based off impulse or what you heard on TikTok. TikTok is not the end all be all. Mm-hmm. TikTok is not, you know, that's not, oh, TikTok say create an S Corp. So don't do that. Speak to your accountant first.
So I would like to we're gonna get into that in the next episode. Okay. I want to know more about business structure. When should I have an S Corp? Mm-hmm. Is it okay? Like, what's the value of having an S Corp, and like what's the proper rate of structuring these things? I have a lot of more questions for you because it seems like you have a lot that you can, like, you know, provide and help me with. So we want to hold on to that. Okay. And I want y'all to like, comment, and share, and tell us what you think about this episode. What did you find any value? Do you have any questions for her that, you know, she could answer for you? Mm-hmm. So I thank y'all for tuning in, and we will see y'all next episode of Wealth Without the Gamble TV.